Today, I'm revealing the ultimate Canadian covered call ETF tier list for 2025, categorized into S tier, A tier, and B tier, so you know exactly where to put your money for passive income. And before we dive in, please note that all yields mentioned in this video are subject to change, so always verify your current yields and do your own research before investing. Now, let's start with S tier covered call ETFs. These are the absolute best of the best, the foundation of any successful Canadian income-focused portfolio. And first up, we have HDIV from Hamilton ETFs, which is the gold standard for diversified covered call exposure, with a current yield of 10.96%. And what makes HDIV exceptional is broad diversification across multiple sectors while employing a sophisticated covered call strategy. HDIV has consistently delivered stable distributions with the potential for increased dividends over time. The powerful advantage here is that HDIV doesn't put all your eggs into one sector basket, unlike concentrated sector plays. HDIV spreads risk across financials, technology, energy, and other key sectors. This diversification, combined with the income enhancement from covered calls, creates a compelling risk-adjusted return profile. HDIV is best for investors wanting diversified covered call exposure with Canadian tax efficiency. The main advantage is the consistent income generation with that lower volatility than pure equity plays, and this is why it makes an excellent core position in any covered call ETF portfolio. Now, next up in our S tier is Bank from Evolve, which focuses on Canada's big six banks with a covered call overlay, delivering a yield of approximately 15 to 17%. And what most Canadians don't realize is that Canadian banks are among the most stable and profitable in the world, and Bank enhances that income stream through strategic options writing. The tax advantage that most advisors won't clearly explain is that you're getting exposure to Canadian dividend paying banks, which qualify for the dividend tax credit, plus the enhanced income from covered calls. So for higher income earners, this creates a powerful tax efficient income stream. Bank delivers solid low NAV erosion with consistent yield, giving you exposure to Canada's financial backbone. It's best for conservative income investors wanting Canadian banking exposure with enhanced yield. The main drawback is the sector concentration risk if Canadian banks underperform. And now completing our S tier is UTES, also from Evolve, which takes top Canadian utility companies and enhances the yield through covered calls, currently delivering approximately 15 to 17% yield. Again, the stability factor here is tremendous. Utilities are recession-resistant businesses that people need regardless of economic conditions. UTES provides solid, low NAV erosion with consistent yield while giving you exposure to essential Canadian infrastructure, including utilities, telecoms, and pipeline companies. The covered call strategy enhances what are already typical, reliable dividend payers. It's best for ultra-conservative income investors wanting utility exposure with enhanced yield. Since this fund is relatively new, it launched in 2024, it's still establishing its track record, but early performance has been very strong. And very quickly, I noticed that over 80% of viewers who watch this channel aren't subscribed. An easy way to support this channel for free and help me reach my 10,000 subscriber goal by New Year's is by hitting that subscribe button. Thank you. Now, let's move on to our A tier covered call ETFs, which are excellent core positions that just miss the highest tier, but are still great core positions. First, in our A tier is HYLD from Hamilton, which holds a diversified portfolio of Hamilton's own sector-specific covered call ETFs and currently yields 12.7%. The powerful advantage here is that you're getting enhanced income from broad S&P 500-like exposure through Hamilton's yield maximizer ETFs that cover different sectors. HYLD essentially gives you a one-stop solution for diversified US market exposure with covered call income enhancement. Instead of buying multiple sector-specific covered call ETFs yourself, HYLD packages them together in the right proportions to mirror the S&P 500 sector weighings. Next up is QQCL, which writes covered calls on the NASDAQ 100 and delivers high monthly distributions. The growth potential here is substantial since you're getting exposure to the world's leading technology companies like Apple, Microsoft, Google, and Amazon, but with enhanced income through the covered call strategy. QQCL is perfect for investors who want tech exposure, but also want monthly income. The NASDAQ 100 has historically been one of the best performing indices, and the covered call overlay provides regular cash flow. Also in our A tier is USCL, which provides high monthly distributions and gives you broad S&P 500 exposure with covered calls and modest leverage. This gives you exposure to the largest US companies with enhanced income. And rounding out our A tier is ENCL, delivering high monthly distributions from Canadian energy exposure with covered calls. This ETF provides leverage exposure to Canadian oil and gas companies with the income enhancement of covered calls. It's a strong position for those wanting Canadian energy exposure with high monthly income. Now, let's look at our B tier covered call ETFs. So these are solid options, but have specific limitations that keep them from our higher tiers. First in our B tier is HHIS from Harvest, delivering approximately 20 to 24% yield and offering capital appreciation potential with high yield. The strategy here combines growth-oriented holdings with aggressive income generation through option strategies. HHIS would actually be a lot higher in our rankings, and it's performing amazingly well with both high yields and capital appreciation, but it launched in January 2025, making it extremely new with a limited track record. The fund is also significantly more concentrated than our S and A tier picks, so that concentration risk and newness make it a higher risk, which is why it lands in B tier despite its excellent performance. Next is QDay from Hamilton, which launched in July 2025 and uses 0 DTE options. That's 0 days to expiry options on about 20% of its Canadian equity holdings. This is a much more aggressive strategy than traditional covered calls, but early performance has been impressive. QDay would rank higher based on its innovative approach and strong early returns, but it's also still a very new fund. We need more time and market cycles to properly evaluate its performance and risk profile. The same goes for SDAY from Hamilton, which also launched in July 2025 and uses the same 0 DTE strategy, but on the S&P 500 holdings. Like QDay, it shows promising early results, but needs more time to establish a track record. Both QDay and SDAY represent interesting innovations in the covered call space, but their newness and aggressive option strategies place them in B tier for now. And before we wrap up, it's important to mention that we are leaving out single stock ETFs like MSTE, that's the MicroStrategy Enhanced, and NVHE, NVIDIA Enhanced. While these can be compelling for specific situations, we're only including diversified index ETFs in the rankings to focus on broader portfolio building blocks. So now let me share the strategy I'm leaning into for my own portfolio using these core positions. My core holdings include HDIV for diversified base, Bank for Canadian banking, UTES for utility stability, HHIS as a higher yield specialty position, possibly USCL for S&P 500 covered call exposure, and then QDay as a speculative position that's a little bit too new right now to rank higher. Same with SDAY as another speculative position that's too new to rank higher, and a little bit of MSTE, which is a single stock ETF that I could never recommend to most investors. But as you can see, I have ETFs from S tier all the way to B tier in my portfolio. QDay and SDAY are speculative positions because while I think they're innovative products, they're just simply too new to properly evaluate. And then there's MSTE. This is a single stock ETF focused on MicroStrategy. And while it's actually a fairly large position in my portfolio, I did minimize it. I can never recommend this to my audience. It's far too volatile and concentrated for most investors, but I want to be transparent about what I'm actually holding. And you can see my entire covered call portfolio in the link below and first pinned comment. So this shows that there are many different ways you could allocate between these depending on your investment goals, risk tolerance, and income needs. Now watch these two videos for more investing tips. Bye guys.